How will the Lok Sabha elections impact your investments? Should you wait till the election results are announced to invest money, or should you invest right now? Then what about your SIPs and mutual fund investments? Should you stop them or continue? In this video, I'm going to share a detailed analysis of how elections in India have affected the stock market, and I'm also going to dive into 3 strategies that you can use today to actually invest your money. Hello everyone, I'm Udayan Adhye. I've been licensed in the financial services space in India since 2015, first in insurance and then in mutual funds. I have helped over 1,000 families make better financial decisions, and of late, a lot of people are worried about how their investments would perform because of the elections. They wonder if the markets would crash if the BJP does not get re-elected. On the other hand, they also fear missing out if they don't invest and there's a massive rally in the markets if the BJP wins with an outright majority. In fact, Prime Minister Narendra Modi himself said that the markets will shoot up once he wins on the 4th of June. Now, on the face of it, elections can shake up things. They might bring in new policy changes or change old ones, impacting everyone from you to me and big businesses. This uncertainty or hope of what's coming next can make the market jump or drop. I'm going to cut through all the noise in this video. We'll go through the past general elections in India and how the stock market has performed before the election, how it moves on the day of the result, then how it performs 6 months later, 1 year later, and 5 years later. Now let's crunch the numbers on how the markets have moved on the election result day. On 18th of May 2009, when the second UPA government was re-elected, the stock market shot up by guess how much? 17.33% on one day. The election result was actually declared on a Saturday. The Sensex had closed at 12,173 on Friday, 15th of May, and then on Monday, 18th May, the Sensex opened at 13,479 and closed at 14,284, registering a 17.33% gain, which is absolutely crazy when you think about it and as wild as a move can get. But keep in mind that this was after the crash of the 2008 financial crisis. So the stock market had already fallen 61% from about 20,800 in January 2008 and had not yet recovered fully. And that could have also played a role in this massive rally. What about other years though? On the election result day in 1999, the stock market went down by 0.2%. Then in 2004, when the BJP-led NDA alliance lost the elections, the stock market actually gained by 0.8% on 13th of May. Then when the BJP won in 2016, the stock market went up by 0.9% on 16th May. And the last time around, in 2019, when they won, the market went down by 0.8%. So as you can tell, apart from that one time in 2009, the stock market was pretty flat on the day of the election results. Though how does the stock market behave before the elections? So in 1999, 6 months before the election, the market rose by 32%. This was partly because of the huge rally that was taking place during the dot-com bubble. In 2004, it went up by 8%. In 2009, it again rose by a whopping 30%. But again, keep in mind, this was partly due to the recovery post the 2008 crash. In 2014, when the BJP came to power, the market went up by 14% and then again by 19% in 2019. The average 6-month gain has been 19.6%, but that was helped by 2 stellar periods in 1999 and 2009. What about the after-election performance though, which is more relevant right now? And this is where it gets really interesting. The stock market has always delivered a positive 6-month return every time after the last 5 elections. It rose by 4% in 1999, by 10% in 2004, by 38% in 2009, 17% in 2014, and 4% in 2019. Now let's expand our time frame to 1 year post-election. In 1999, the stock market was down 12%. But it's important once again to understand that this was the time of the dot-com bubble crash. Then in 2004, it went up by 19%, by 38% in 2009 and 16% in 2014. But in 2019, it was down minus 21% 1 year after the elections. But again, keep in mind, these were COVID-19 times and all major stock market indices across the world had crashed. Because of two bad years in 1999 and 2001, the average 1 year return post-election has been 8%. Then the 5-year annual return post-elections has ranged between 7.07% in 1999 to 17.96% in 2004. To put this in perspective, the average 5-year annual return since October 1999 of the Indian stock market has been 15.39% irrespective of elections. So once again, as you can see, there is no conclusive evidence of stock markets rallying or crashing only because of elections. When you analyze this data, one point becomes very clear. During the past 5 elections, the stock market has done very well 6 months before and 6 months after the election. Even in 2024 right now, as of 23rd of May, the stock market is up over 14% in the past 6 months and we're about 2 weeks away from the election results coming out. Now, having said all of that, apart from the 6 months strong performance before and after elections, there is no strong data that suggests that elections have a lasting impact on the stock market. In fact, in my opinion, it has a temporary effect, if any. And the elections are one small data point amongst many others that drive stock market behavior. Also, if you're finding this video useful so far, a sub to my channel will compound your investment knowledge. Now, with all that being said and being kept in mind, how should you approach investing? If you really get to the bottom of your fear of investing right now, you would realize that it either comes from the fear of losing money if you invested or not taking part of the rally if you don't invest. Now, these fears are rooted in psychological biases, specifically loss aversion and fear of missing out or FOMO. Loss aversion makes us fear losses more than we value gains. Now, imagine for a second that you find a 1000 rupee note on the street. That would feel pretty awesome, right? Now think about losing 1000 rupees. That would hurt a lot more than the joy of actually finding it. Do you agree? That is loss aversion in a nutshell. It's a natural tendency that we have where the pain of losing something is way more intense than the pleasure of gaining the same thing. This can make us super cautious and sometimes even scared to take risks, even if the potential rewards are pretty sweet. Basically, we are wired to avoid losses more than we are to chase gains. FOMO, or fear of missing out, on the other hand, makes us worry about missing out on potential gains that others might enjoy. I mean, just imagine your friend telling you that they made a 50% profit of 1 lakh rupees in just 1 month because they had invested just before the elections and their stock went up because of the rally after the elections. Not only will you feel bad about not investing money yourself, but you will feel worse because you did not do as well as your friend. Keeping all that in mind now, here's how you can actually invest money. I'm going to share some strategies with you. First up, if you have an SIP, continue with that SIP since SIPs are anyway one of the best ways to lower your risk since you spread your investments over different months and buy at different prices. On the other hand, if you have a lump sum one-time amount to invest, you can take one of 3 approaches depending on how they make you feel. Firstly, if the money you have is less than 10% of your total portfolio, just invest it in one go because it's a small amount anyway on a relative basis. Secondly, if it's more than 10% of your portfolio that you want to invest, you can consider phasing your investment into the stock market over 6 months. And this can be done through what is called as a systematic transfer plan or an STP. In it, you first invest the entire amount in a holding fund, which could be a debt fund, like for example, the SBI Liquid Fund. And then by setting up an STP, you give a standing instruction to SBI Mutual Fund to transfer your money from the holding fund to your target equity fund, which let's say is the SBI Magnum Mid Cap Fund. Now, through an STP, you decide beforehand how much money gets invested, how frequently your money gets invested, and where your money gets invested. This way, you're taking out the entry risk that is associated with investing, since you have now 6 different entry points over 6 different months. Having said that, even if the amount that you want to invest is higher than 10% of your total portfolio, you can still invest it in one go if you're comfortable with it. Because if you think about it, 3 scenarios may take place when you invest your money. First up, the market goes up, then the market goes down, and the market moves sideways. Except for scenario 2, you end up winning. Now, only do this though if you're okay with the value of your money going down by say 20% in the next 6 months. That's because the stock market in the short run is volatile and you should be comfortable with seeing the value of your money go down. Remember, there is no best way to invest your money, and what helps you stay invested in the market during its various ups and downs is the best way to invest money. So tell me in the comments how you are going to invest money this election season, and I'll catch you in the next one.